News of the Bank for International Settlements. Held under the work program of the International Financial Architecture and Framework Working Groups under the Indian G20 chairmanship, today's workshop on global economy, challenges, opportunities, and ways forward includes 3 panel discussions, includes rich and insightful thoughts on development finance and deepening all good things, addressing global debt vulnerabilities, and there are risks to the global economy. All these issues are a priority under India's G20 presidency. I will use this opportunity to speak to all participants for improving the quality of the discussion throughout the day. Today, prevalent organs around the world are manifesting a wide range and wide spectrum of post-pandemic recovery disruptions with heightened sensitivities, financial market vulnerabilities, stockpiling, and geopolitical urgency. This G20 Indian presidency aims at global cooperation to meet such important challenges. This is embodied in the theme of Vasudhaiva Kutumbakam's presidency. One land, one family, one future. This topic is extremely dangerous for the general prosperity of all. Global public goods play an important role in the social development of peoples, regardless of borders and peoples. Their funding has become a critical issue following the COVID-19 pandemic, highly volatile geopolitical environments, climate change, disruptions in international probability chains, and tectonic shifts in financial market and global liquidity conditions. The possibility of cumulative consumption of such resources, the global financial aggregate, is becoming increasingly important in the mineral hierarchy. India's experience has shown how digital public infrastructure can be used to access financial services and income by reducing costs. Our continued involvement with the Indian stack and the single payments interface, especially during and after the pandemic, has fueled our commitment that digital public infrastructure like UPI can be an advantageous part of a wide range of benefits if expanded to border communities. While UPI was a public sector initiative, it is not necessary that public goods be included and funded by the public sector alone. The private sector needs a stake in the GPG, not only because they have proven to be a natural ecosystem for businesses to thrive, but also because it would be a commercial intrusion. In this regard, it makes sense to create investment constructs that private investors bring in to finance PIP. In the investment cascade, it is noteworthy that investment needs are very important. The trigger cover can come from public investment. This has helped to capitalize on and expand market access. Subsequent funding needs can be met by the individual sector. This is where the magnitude of the value stream comes into play. Therefore, the income must be significant. In this pursuit of multilateral development of banks, private sector investment could be stimulated using risk sharing. Recent charges on a global scale to the insufficiency of large public goods and the erosion of economic growth. An illustrative reason is the lack of unhindered access to vaccines against COVID-19. Similarly, the lack of need for financial support and cooperation with creditors may be explained, albeit in part, by growing debt stress in some countries. The high and unacceptable level of protection severely limits the ability of many countries to review. Although G20 initiatives such as the Common Defense Framework and debt service suspension initiatives have been widely discussed, their progress needs to be exceeded. I would like to make 3 specific proposals. First, it is important that countries' debt sustainability analyses are realistic in terms of growth, and that budget projections are fully based on accurate and comprehensive debt data. A global debt data exchange platform can help in this regard. Creating such a platform can be a very difficult task and may take several years. Therefore, during the interregnum, we can explore the possibility of building suitable intermediaries to manage debt flows. Such indicators can be derived from capital flow data and local banking statistics from sources such as the Institute of International Finance and the Bank for International Settlements. Second, a multilateral debt relief program that provides targeted assistance to low-income, heavily indebted countries should be considered as a matter of priority. This initiative could be designed with a clear focus on the use of debt relief for sustainable development projects and poverty reduction efforts. To this end, instruments such as Debt for Development Swaps 1 and Green Debt Relief Programs 2 could be used. Third, the critical role of the International Monetary Fund and the World Bank in addressing global debt vulnerabilities cannot be overestimated. These institutions are at the center of the international monetary and financial system. Therefore, they have a responsibility to do more for countries in debt distress. IMF precautionary programs such as the Precautionary Credit Line are currently available to countries with sound macroeconomic performance. However, countries with strong macroeconomic performance have little reason to take precautionary measures. In addition, standby agreements, SBS, are proposed for countries with a balance of payments crisis, but SBS have performance benchmarks and an associated stigma. This is an important question, as recent experience shows how the perceived stigma and/or lack of access to IMF programs can lead countries to seek support from other creditors than the IMF, with implications for debt sustainability. It might be useful if programs could be designed with lesser conditions for countries with unreliable but fairly robust macroeconomic performance, as long as they are not subject to balance of payments stresses. The key point I'm trying to make is that corrective action, including funding, must be taken in a timely manner, without stigmatization, and with more open access. For this purpose, a larger and stronger IMF that can manage country risk levels is critical. Since IMF support is linked to the size of countries' quotas, the 16th General Review of Quotas and related requirements, including governance reform, needs to be completed expeditiously. In addition to enhancing the legitimacy of the IMF in its oversight of the international monetary and financial system, this will enhance the effectiveness of the IMF's policy advice. We must not let the debt burden stifle the potential for global growth. In this regard, a discussion forum on the key risks to global growth, namely inflation, financial stability, and climate change, becomes relevant. Even as the outlook for the global economy is clouded by downside risks, long-term structural challenges, such as climate change, need to be addressed by providing adequate and affordable financing for the transition to green technologies. We must, however, be mindful of the potential implications of a transition to a green economy for financial stability. Transition efforts must take into account both the physical and transitional risks of climate change. A smooth and orderly transition to a green economy is needed to avoid disruption to economic activity and loss of growth potential. While the investment needs for a smooth transition to a green economy are large, actual financial flows for green projects are highly skewed and largely concentrated in advanced economies. There is an urgent need to increase the flow of green capital to EMDs. As the IMF noted in a recent Global Financial Stability Report, green capital inflows to EMDs are limited by an insufficient supply of green-rated investment projects. While green flows today depend on ESG ratings, recent research suggests that these ESG ratings do not adequately reflect the financial and non-financial significance of these investments. Therefore, it is necessary to ensure that green ratings reflect the actual environmental impact of projects in order to avoid greenwashing. A critical aspect of these efforts is securing private funding for climate change efforts through globally comparable and transparent disclosure standards and a taxonomy of green activities. The International Sustainable Development Standards Board, ISSB, is actively working on these aspects. While efforts are being made to improve and deepen green finance, it is equally important to strengthen the regulatory framework that will allow for the implementation of climate taxonomy in all jurisdictions, prevent flushing, and encourage sufficient green capital inflow into EMD. An integrated, collaborative approach involving governments, private sector organizations, financial institutions, civil society organizations, and the general public is essential to ensure a successful transition to a sustainable future. Let me conclude by saying that structural challenges such as financing global public goods, managing global debt vulnerabilities, and addressing climate change are complex challenges that no country can tackle alone. Reaffirming the commitment to multilateralism is an urgent need, and this is exactly what the Indian G20 presidency is trying to promote. It is also important to take note of the transformational people-centric changes taking place in member countries, such as UPI and financial inclusion initiatives in India. Wider adoption of such models would make the world a better place for everyone.